It feels like managing money is always on our minds, doesn't it? Whether you're sort of dreaming about that bigger loan for a house or maybe upgrading the car or just, nervously checking your savings balance online, money stuff is, well, it's central. And right now, there's a pretty major development happening here in India that's likely to touch those plans and balances for you. We're talking about India's biggest bank, State Bank of India, SBI. They've just made some pretty substantial changes to their interest rates, lending and deposits. This isn't just like routine financial news. It feels like something that could genuinely shift things for your personal finances.
Yeah.
So based on the info we've gathered, our mission today is to really dig into this, pull out what matters most, and figure out what these SBI changes mean for you, whether you're thinking of borrowing money or trying to make your savings grow.
Yeah, it's definitely a significant move, and it tells us a lot about, the wider economy and the signals coming from the Reserve Bank of India.
Exactly. So let's jump right in. The headline news. SBI is making major cuts to its lending rates and, at the same time, tweaking some deposit rates. And the key date for all this, June 15th, 2025.
That's the one, June 15th. So for borrowers, the big news is a cut of 50 basis points. That's across their main external lending benchmarks.
Okay, which ones are those again?
We're talking about the external benchmark-based lending rate, the EBLR, and also the repo-linked lending rate, or RLLR. Both are down by half percentage point.
Right, 50 basis points, half
Yeah.
percent. Just quickly, for anyone maybe not familiar, a basis point is tiny, right? 1/100th of 1%.
Exactly. So 50 BPS is, precisely 0.5%.
Yeah.
Doesn't sound huge, maybe, but...
But apply that to a big loan over many years, and suddenly it's not so small anymore.
Precisely.
Let's try and make that real. What does this actually look like for someone borrowing, say, a home loan? That's pretty common, maybe 50 lakh over 20 years.
Good example. So if your loan was linked to one of these benchmarks, let's say EBLR, your rate might have been around 8.90%. Your monthly payment, your EMI, would be somewhere around 43,867 IS.
Okay. And now with this cut.
With the 50 BPs cut, that rate could drop to 8.40%. And your estimated EMI, that could fall to roughly 43,000 per month.
Ah, okay. So that's what? Nearly 800 euro, 900 difference every single month.
Yeah, around 800 or so, give or take. And that's real money back in your pocket month after month.
It really is. Over the whole loan, that's significant, but you feel that 800 straight away. That's, I don't know, a few decent coffees, maybe covers your streaming subs, something tangible.
Definitely. And it's crucial to remember this isn't just for home loans.
Right.
If you have a car loan, maybe a personal loan, or importantly, a small business loan, if it's tied to EBLR or RLLR, you should see a similar benefit.
So it applies pretty broadly then.
Yes. For instance, the RLLR specifically is now down to 8.00%. That's quite helpful, especially for, say, MSME borrowers, small and medium businesses who often use that rate.
And this isn't just for people taking out new loans, is it? What about existing borrowers?
Good point. No, if you already have a loan and your agreement links it to EBLR or RLLR, your rate should automatically adjust downwards starting from June 15th.
So it's worth digging out your loan agreement and checking which benchmark applies to you.
Absolutely. Definitely check the fine print.
Okay, so why is SBI doing this now? What's the trigger?
Well, the big driver here is the Reserve Bank of India, the RBI. Just about a week before SBI's announcement, on June 6th, the RBI itself made a pretty big move.
Right, I remember hearing about that.
They cut their main policy rate, the repo rate, by a full 50 basis points, took it down to 5.5%.
Okay, the repo rate. Remind us quickly what that is.
Sure. The repo rate is basically the interest rate at which commercial banks like SBI borrow money directly from the RBI. Think of it as the wholesale cost of money for banks.
Gotcha.
So when the RBI lowers that rate, it becomes cheaper for banks like SBI to get funds.
And they pass that saving on.
Yeah. Well, that's the idea. It creates room for them to lower their own lending rates, and honestly, there's an expectation from the RBI that they will pass it on. It's the RBI's main tool to make borrowing cheaper across the whole economy.
Okay, so cheaper loans, that's the good news side for borrowers.
Yeah.
But there's always another side, isn't there? Usually involves savers.
You nailed it. That's the flip side. When banks earn less on the loans they give out, they also need to manage their own expenses. And a huge expense for any bank is the interest they pay out on deposits, your savings.
So if lending rates fall,
Deposit rates often follow, And that's what we're seeing. Alongside the loan rate cuts, SBI is also trimming some of its rates for fixed deposits.
Okay, let's look at an example for savers. They have that special deposit, the Amrit Vrishti one, right?
Yeah.
444 days.
That's right, a popular one. The rate on that specific scheme is being cut by 25 basis points.
Okay, 25 BPS, so not as much as the lending cut, but still a reduction.
Correct. It's dropping from 6.85% down to 6.60%, also starting June 15th.
And what about senior citizens? They usually get a bit more.
They do, yes. SBI is maintaining that differential. Senior citizens will get 7.0% on that Amrit Vrishti deposit now, and super senior citizens, they get 7.20%, so still a premium there.
Okay. Are other FD rates changing too for like regular 10 years?
Yes, there are other adjustments, mainly for deposits under 3 crore. For example, FDs for 1 to 2 years, that rate is down 10 basis points to 6.70%.
Okay.
And for deposits between 2 and 3 years, the rate is now 6.90%. That's down from 7% previously.
And what about bigger deposits, bulk deposits? Are the cuts deeper there?
Seems so. For those larger amounts over 3 crore, the cuts are a bit sharper. Like 180 to 210 days sees a 20 BPS cut down to 6.40%. And for 211 days up to just under a year, it's a 25 BPS cut, taking the rate to 6.50%.
Interesting. And they have those slightly unusual green rupee deposits too, with the funny day count.
Yes,
Yeah.
the 1111, 7077, and 2222 day deposits. Those green repeat term deposits are generally priced about 10 basis points below the standard rates for similar durations.
Okay. But the main reason for cutting these deposit rates, it's purely about protecting their own profits, right? Their margins.
Essentially, yes. It's about managing their net interest margin, or NIM. That's the difference between the interest they earn on loans and the interest they pay on deposits. If loan earnings fall, they need to reduce their funding costs, what they pay depositors, to keep that margin healthy.
And this isn't just SBI doing this.
No, not at all. It's a wider trend. We've seen FD rates generally drifting downwards across the banking sector since around February this year, cuts ranging from, say, 30 to 70 basis points in some cases.
Right. Which brings us back to the RBI's overall strategy. This latest 50 BP's repo cut wasn't out of the blue, was it?
Not really. If you look back, this is actually the third time the RBI has cut the repo rate just this year.
Third time. Wow.
Yeah. There's a 25 BPS cut back in February, another 25 BPs in April, and now this bigger 50 BPs cut in June. That adds up to 100 basis points, a full percentage point since February.
That's quite rapid.
It is. It's actually the sharpest easing cycle, meaning the fastest pace of rate cuts we've seen in India since the major disruption back in 2020.
So why the rush? Why is the RBI cutting so quickly? What's driving this urgency?
The main reason is trying to boost economic growth. You know, the latest figures we got for Q2 of FY25 showed the economy growing at 5.4%.
Okay, 5.4%, which sounds okay, maybe.
It's not disastrous, but it was the slowest growth rate we'd seen in 7 quarters, nearly
Wow.
2 years. So that sluggishness is definitely a concern for the central bank.
Ah, I see. So they're trying to give the economy a shot in the arm.
Exactly. Lower interest rates make it cheaper for businesses to borrow and invest, cheaper for people like you to borrow for big purchases like homes or cars. It's about injecting some momentum.
Makes sense.
And it's not just domestic factors. There are also global headwinds to consider.
Like what?
Well, you see rising trade tensions internationally. Things like the U.S. putting those huge 104% tariffs on some Chinese imports. That creates uncertainty, potentially affects exports for countries like India.
Right, ripples across the globe.
Precisely. So the RBI is likely being a bit preemptive, trying to strengthen domestic demand through lower rates in case the global picture gets worse. That's probably why the governor, Sanjay Malhotra, also slightly lowered the GDP growth forecast for next year, FY26, down to 6.5%, though they are still projecting inflation around 3.7%, assuming, the monsoon is decent.
Okay, so rate cuts to boost growth. But wasn't there something else the RBI did recently, too? Something about reserves?
Ah, yes. Very important point. They didn't just cut the repo rate, they also made a big cut to the cash reserve ratio, the CRR.
CRR.
Yeah.
That's the money banks have to keep locked up with the RBI, right? They can't lend it out.
Exactly. It's a percentage of their deposits they have to park with the central bank, earning no interest. The RBI cut the CRR by 100 basis points, a full percentage point, bringing it down from 4% to 3%.
Okay, and what does a 1% cut in CRR actually do?
It does a lot. By lowering the CRR, the RBI effectively unlocked and injected a massive amount of liquidity back into the banking system. The estimate is around 2.5 trillion.
2.5 trillion rupees. Wow. That sounds enormous.
It is. It's basically like giving the banks a huge infusion of lendable cash. So think about it. The cost of borrowing from the RBI is down because the repo rate fell. And banks now have a much larger pool of their own funds available to lend out because the CRR fell.
So it's a double boost for lending capacity.
Absolutely. It provides really strong support for these lower lending rates we're seeing from SBI and others. It ensures banks actually have the money to lend if the lower rates succeed in stimulating demand.
So SBI got the headlines because they're the biggest, but this is really a market-wide thing, isn't it? Other banks must be reacting too.
Oh, definitely. It's creating ripples. Other big public sector banks, Bank of India, Bank of Baroda, Bank of Maharashtra, they've also announced lending rate cuts, typically in that 25 to 50 basis point range.
Competition kicking in.
Exactly, which is good for borrowers.
Yeah.
We're even hearing reports that some prime borrowers might be able to get home loans for as low as 7.90% now, depending on their profile.
Below 8%, that's a psychological barrier.
It is. And even private banks like HDFC are making adjustments, although sometimes they seem more focused on tweaking savings account rates rather than matching the big external benchmark cuts point for point.
But you mentioned earlier that not all loans are benefiting equally. Something about MCLR.
Right, that's a really key distinction. These big cuts we're talking about apply to loans linked to the external benchmarks, EBLR and RLLR. If you have an older loan, maybe a car or personal loan that's linked to the internal benchmark, the MCLR marginal cost of funds-based lending rate, you might not see a change just yet.
Great. Why the difference? If the RBI's rate is down, why wouldn't MCLR fall too?
It's because of how they're calculated. EBLR, RLLR are directly tied to external rates like the repo rate, but
Yeah.
MCLR is based on the bank's internal cost of funds.
Meaning their deposit costs.
Primarily, yes. It includes the average cost of their deposits, other borrowing costs, operational expenses. And the reason MCLR isn't falling as fast, especially for maybe the one-year MCLR, which SBI kept at 9%, is that banks haven't cut their deposit rates quite as sharply across the board.
Why not? If lending rates are down?
Because credit demand, while maybe not booming, is still pretty decent. Businesses and individuals are still borrowing. As long as loan demand holds up reasonably well, banks feel less pressure to aggressively cut the interest they offer on deposits to attract funds. They need those deposits to lend out. So they're holding deposit rates a bit steadier for certain periods, which keeps the MCLR relatively higher. SBI's chairman even mentioned that deposit rates might stay put for a bit longer because credit growth hasn't really cooled off yet.
It really highlights the balancing act banks have to perform, doesn't it? Pass on the RBI cuts to borrowers, stay competitive, but also protect their own profitability by not slashing deposit rates too much if they still need the funds.
It's a constant juggle.
And that massive $2.5 trillion from the CRR cut must give them significant breathing room to manage that juggle. More funds available makes it easier to lend, even if margins are slightly squeezed.
Precisely. It provides a big liquidity cushion.
It almost makes those odd deposit tenors, 1,111 days, 1,777 days, make a bit more sense. Maybe it's a way to attract specific funding without cutting standard rates across the board.
Could be. It's about finding pockets of funding and maybe standing out a bit when savers are looking closely at rates.
Okay, so looking forward,
Yeah.
what's next? Are more cuts likely?
Well, based on the current economic picture and the RBI's focus on growth, a lot of analysts are expecting maybe at least one more rate cut from the RBI.
Oh, really?
Yeah, the consensus seems to lean towards another 25 basis point cut to the repo rate, possibly around the October policy meeting. That would take the repo rate down to 5.25%.
Now that happens.
If that happens, and if inflation behaves itself, stays under 4% ideally, and the global situation doesn't worsen significantly, well, then we could realistically see home loan rates for good borrowers dipping below that 8% mark more widely.
That would be quite something. Now, for people with existing EBLR, RLLR loans, even though the cut is effective June 15th, does the lower EMI kick in immediately?
Technically, the rate changes then, but it might take a little while, maybe up to a reset cycle, which is often quarterly, for the lower EMI calculation to fully reflect in your actual payment. Depends a bit on the bank's process.
Okay, something to watch out for. And for savers. What's the outlook on FD rates? More cuts likely there, too.
The pressure is certainly downwards. With lending rates falling, banks will feel pressure on their margins. Some rating agencies like ICRA estimate margins could shrink by about 15 basis points.
Ouch.
Yeah. So to protect profitability, further gradual cuts to FD rates seem quite possible, maybe likely, especially for private banks, which tend to have more loans linked to these external benchmarks.
So for savers, it's a tricky time.
It is. It might be a moment to look at the rates currently on offer, see if they still work for you, maybe consider locking in a rate now if you find a good one, or perhaps exploring other options like certain debt mutual funds. But always be mindful of the risk involved with anything other than a guaranteed bank deposit. No free lunch, as they say.
Yeah. Right. So pulling it all together then, the big picture from SBI's move, really reflecting the RBI's push, is clear. Good news for many borrowers. That 50 BP's cut on key loans means lower EMIs start, well, right about now, June 15th.
Definitely. If your loan is linked to EBLR or RLLR, home, car, personal, MSME, you should benefit. But for savers, it's a different story. Expect slightly lower returns on fixed deposits, though senior citizens still get that preferential rate.
So the key actions for you, the listener. First, check your loan documents, see what benchmark rate applies EBLR, RLLR, or MCLR. That tells you if you benefit now.
Second, if you're saving, look at the current FD rates. Are they still meeting your needs? Maybe lock one in, or consider if you need to look at other options, carefully weighing the risks.
And third, keep an eye on what the RBI does next. Their decisions are clearly driving the bus right now.
Absolutely. Future policy meetings will be key.
Because ultimately, in this world of shifting rates and returns, it's your money we're talking about. Staying informed, understanding why these changes are happening, like we've tried to break down today, is just so vital. Because, yeah, no one's giving away free money here. You got to know the landscape.